In 2018, I purchased my first rental property. Fast forward to 2024, the rent I collect from a real estate investment now accounts for half of my retirement income, allowing me to leave my corporate career this year. The other half comes from equity investments. Remarkably, it just took 6 years for my real estate portfolio to reach this level, a milestone that took my equity portfolio 2 decades to achieve by comparison. In my last video, I emphasized that wealth building is often a gradual process, achieved step by step, block by block. While this remains true, certain accelerators and strategies can significantly fast-track your journey to financial independence. In this video, I will focus on residential rental properties, specifically single-family homes, and explain why this asset class is a powerful wealth-building accelerator that can easily outperform the stock market over time with lesser volatility. Here's what I will cover: key value characteristics, tax loopholes, the power of leverage, risk, and mitigation. Without further ado, let's explore the 4 key value characteristics of single-family homes. Number 1, natural appreciation. The value of the land a house sits on appreciates over the long term, driven by the fundamental principle of supply and demand. While the supply of the developable land is limited, the demand is influenced by various micro and microeconomic factors, including population growth. Positive immigration and birth rates mean higher demand for housing at the country level. State government policies, regulations, tax incentives, and zoning laws affect the desirability and affordability of the real estate in the area. Local infrastructure and amenities, proximity to quality schools, parks, shopping centers, and public transportations can boost property value. Business development, job growth in the region often drives out-of-state migration, resulting in an increased demand for housing. These factors underscore the timeless advice when buying real estate: location, location, location. Number 2, forced appreciation. Unlike equities where you have little to no control over assets value, real estate offers the unique benefit of forced appreciation, where property's value increases through improvements. For instance, converting a garage, attic, or porch into additional climate-controlled living space can add bedrooms or bathrooms. Upgrading kitchens or bathrooms to modern standards make the property more attractive and desirable. Landscaping or building an accessory dwelling unit or ADU creates additional rental income opportunities. This ability to directly influence a property's value is a critical advantage of real estate over stocks or bonds. Number 3, value independence and liquidity. Single-family homes value is not directly tied to rental income, unlike commercial properties such as apartment buildings. Commercial real estate is appraised based on the profitability of these operations, making its value similar to that of a business. An empty single-family home can sell for just as much as an occupied one. Additionally, single-family homes appeal to a broader pool of buyers, including families purchasing for personal use, making them generally more liquid than commercial properties. Number 4, dwelling depreciation. The building of a single-family home depreciates over time. While this may seem counterintuitive for an investment, it provides a unique and significant tax benefit. Since purchasing my first rental property 6 years ago, I haven't paid a single dime in taxes on the positive cash flow generated from rental income. How is that possible? To answer this question, let me now introduce one of the most powerful advantages of real estate investing: the tax loophole. From an accounting perspective, my rental properties appear to operate at a loss. This is due to property depreciation, which is treated as an expense that I can offset rental income, along with other common expenses such as property taxes, mortgage interest, property management fees, insurance, and repairs. Annual depreciation is calculated by taking the estimated building value, the purchase price of the property minus the land value, and dividing it by the IRS allowed residential property depreciation period of 27.5 years. Land does not depreciate because it has an unlimited life. Here's an example. For a $350,000 house, the building value is determined to be $300,000 without land. This results in an annual property depreciation of $10,909, which can be used as a deduction against rental income. Since depreciation is not a real expense I pay, my cash flow positive rental properties generate tens of thousands of dollars in tax-free income each year. This enables me to reinvest that cash flow into acquiring additional properties. It's important to understand that selling a rental property at a profit triggers certain tax obligations. First, you will need to pay a portion of the claimed depreciation known as depreciation recapture tax, which is calculated at your current income tax rate. Additionally, you will owe capital gain tax on the property's appreciation minus transaction fees. However, you can use a strategy called 1031 exchange to defer both capital gains and recapture taxes indefinitely by using the sales proceedings to purchase one or more rental properties. Alternatively, passing the property to your heirs without selling it eliminates these tax liabilities entirely. Meanwhile, you can continue to enjoy tax-free cash flow from the properties during your lifetime. If you decide not to use a 1031 exchange, holding the property for at least a year qualifies you for the lower long-term capital gain tax rate, rather than the ordinary income tax rate. However, the depreciation recapture tax will still apply. Be sure to consult a tax accountant to plan your exit strategy and fully understand your options for maximizing benefits. If you reside outside of the US, be aware that tax policies may vary significantly. Real estate investing does come with some complexities, but the benefits far outweigh the drawbacks. Unlike dividends or capital gains from equity investments, which are taxed as they're earned, the IRS allows you to grow your net worth tax deferred, even when you sell properties. This essentially acts as an interest-free loan from the IRS, enabling you to reinvest and compound your tax-deferred earnings into additional properties, snowballing your wealth exponentially. You might ask how this differs from a 401k or other retirement accounts. Well, let me tell you, with real estate, there are no annual contribution limits, no age restrictions on withdrawals, in this case, cashing out from a sale, and no penalties for early access to your gains. Why is that a big deal? A single rental property has the potential to appreciate hundreds of thousands, even millions of dollars within a few years. The IRS places no limits on how much your after-tax income you can invest in properties or how much you can reinvest into additional ones. This is one of the ways the rich are getting richer. However, conventional loans make it possible for everyday investors like you and me to acquire these properties. In the next section, I will explain the power of leverage in real estate investing. Because single-family homes are classified as residential, lenders can offer long-term conventional loans with relatively low interest rates, even for rental properties. While the interest rate for an investment property is typically about half a percentage point higher than a primary residence, these loans often allow your rental property to achieve cash flow positive. In contrast, commercial real estate loans are generally short-term with flexible interest rates, which are usually 1 to 2 percentage points higher than residential investment loans. This makes commercial real estate investment not only more expensive and riskier, but also time-consuming, especially since they often require active management. Let me illustrate how these loans can significantly enhance your returns with an example. Suppose you purchase a house for $350,000. The bank approves a loan for $280,000 based on a loan-to-value or LTV ratio of 80%. This means your one-time investment is a 20% down payment of $70,000 plus a $5,000 in closing costs, totaling $75,000. The average annual appreciation rate for single-family homes has been 5.5% since 1992, according to Investopedia. Assuming this rate continues without any forced appreciation or improvements, the home's value would grow to $597,000 after 10 years, an increase of $247,000. With an initial investment of $75,000, this translates to a compound annual growth rate or CAGR of 12.7%, which beats the historical average return of S&P 500's 10%. However, real estate is highly localized, and individual markets can outperform the national average. For instance, the Greater Phoenix area experienced a total appreciation of 148% since 2014, almost doubling the national average growth rate. Applying this rate to our example, the property's value after 10 years would increase significantly, resulting in a CAGR of 21.3%. While such rapid growth, partly driven by unique factors like the pandemic, is unlikely to persist in the future, the key is to identify areas undergoing strong development and growth to outperform the national averages. That's not all. Renting out the house for $2,600 per month can yield a monthly cash flow of $347 after deducting the expenses outlined in the table. These figures are based on a real example from one of my rental properties, though my interest rate was even lower. Over the same 10-year period, assuming a 3% annual increase in rent and constant expenses, your net income, including the principal paid toward the mortgage, would total over $136,000. This translates to a 10% annual ROI, return on investment, and an impressive combined CAGR of 24.2%. This more than doubles the return of S&P 500. By reinvesting the tax-deferred rental income along with your salary savings into additional properties and repeating the process, you can accelerate your wealth growth rapidly. This is the exact strategy I used to build my real estate portfolio in just 6 years, which now generates half of my retirement income. This example illustrates an ideal scenario to demonstrate the power of leverage in rental investments. Housing and rental markets inevitably experience boom and bust cycles, as well as challenges like vacancies and unexpected repairs. However, over the long term, residential real estate can significantly outperform the equity market through strategic leveraging, reinvesting, and tax advantages. When comparing leverage in brokerage accounts to real estate, the differences are substantial. In a brokerage account, the typical margin level is capped at 100% of the initial investment, with annual interest rates currently exceeding 11%. By contrast, a home loan usually requires just a 20% down payment, effectively providing 400% leverage on the initial investment at a lower interest rate of 6.8%. Furthermore, unlike brokerage accounts, where margin calls occur if equity value falls below a threshold, conventional mortgages have no margin calls as long as monthly payments are made. By the way, this is also why I stopped using margin for equity investing after the dot-com bubble burst. Like all leveraged investment, using loans for real estate also carries higher degree of risk. During the global financial crisis, property values dropped below typical loan amounts, wiping out the net worth of many investors. These investors often owned multiple properties, some of which had a negative cash flow even before the crash. When tenants lost their jobs and couldn't pay rent, coupled with the broader economic downturn, investors saw other income streams dry up as well. This combination of factors led to mortgage defaults, and banks were forced to foreclose on properties at value below the loan amounts, leaving investors with nothing. I highly recommend the movie The Big Short, which explains how GFC unfolded. For this reason, it's imperative to ensure that each rental property you invest in is cash flow positive and that you keep some cash reserve. Even during a housing downturn with potentially lower rent, you can still make mortgage payments and weather through the storm until recovery. And the market always recovers. Therefore, when passively investing in single-family homes, The primary goal is maintaining positive cash flow, while long-term appreciation is the icing on the cake. Additionally, think of the lender as your business partner, funding 80% of your investments, while you enjoy 100% both of the property value appreciation and rental profits, all for the cost of 6.8% annual interest rate. That's an awesome business partner, wouldn't you agree? This concludes part 1 of residential real estate investing, focusing on the why. In part 2, I will walk you through the how, including the process and tips for finding cash flow positive single-family properties, as well as identifying tenants who will take good care of your property and stay long-term. Happy New Year, and see you all soon in 2025.